Hey guys, what's going on? Welcome back to Stocks with Surfing. So today I'm excited to show off a brand new position in my public portfolio. This is a company I believe is a compounding machine and one that will do very well over many, many decades to come. That company is Netflix. This company has evolved from a simple streaming app into the world's most profitable media powerhouse, boasting over 280 million subscribers globally by combining a massive library of original hits with a new high-growth advertising business. They've built a flywheel that competitors are struggling to match, and it is no longer just a tech company, it is the new global gatekeeper for entertainment. I believe the biggest mistake investors are making in 2026 is thinking Netflix is still just a streaming service. While Disney and Peacock are celebrating finally being profitable, Netflix has already finished that race. They've evolved into something completely different, a global utility for attention. They aren't just competing for your time on the couch anymore, they are competing for the entire entertainment industry. We're talking about a company that now hosts live WWE Raw matches every week. They broadcast NFL games to 300 million people and just launched a FIFA cloud gaming title that puts them in direct competition with PlayStation and Xbox. While the rest of the market is worried about subscriber growth, Netflix is building a moat made of live sports, social gaming, and a $300 billion ad engine. This isn't just a streaming company, it's the new infrastructure of media. So let's talk a little bit why Netflix is trading down about 35% from its all-time highs. So even though Netflix beat its recent earnings expectations and now has over 325 million subscribers, investors are worried about three main things. First, the big acquisition. Netflix is trying to buy Warner Bros. For $82.7 billion. This is an all-cash deal, and investors are scared of the massive debt and the fact that Netflix had to stop buying back its own shares to save up for it. Number two is the slower growth. Wall Street likes companies that keep growing faster and faster. So Netflix warned that its revenue growth might slow down to about 12 to 14% this year compared to 16% last year. This is on the back of stagnating and slightly deaccelerating subscriber growth. Also, the stock is in a cooling off period. After reaching all-time highs in 2025, the stock was priced at a premium. Now there are questions about Warner Bros. Deal and regulatory hurdles. Many traders are taking their profits and leaving the stock. Basically, the business is actually doing great, but the high price tag of its next big move has the market feeling a little bit skittish. In the next segment here, we're going to go over the revenue growth of Netflix, and we're going to see how quickly this company is growing. All right, so let's take a look at Netflix's current revenue. So their 5-year revenue CAGR is 12.5%, which is pretty solid. As you can see in the 2026 revenue estimates for standard premium subscriptions, it's sitting at $48 billion, which is a growth rate of 12 to 14%, which is still very solid growth, even though it is a step back from last year. Now, personally, I do think that the revenue growth will reaccelerate. What you're seeing now is sort of the tailwinds from the Netflix password crackdown start to come to a little bit of an end, but I think their overall business model is extremely strong, and them being a utility for entertainment, I think growth rate should stay pretty strong, especially as they get more live events exclusive on the service. You start getting sports fans, etc. subscribing. You get a whole new audience level. For advertising tier, they're only estimated to do $3 billion in revenue, but that's that's literally doubling the growth year over year from 2025. So that is an extremely quick growing segment of the business. I do expect this is going to be extremely high margin because they use the advertising dollars with the AI engine to help target ads. They're going to make even more money off of less ads with the new ad efficiency. So I have to say, I think they're doing very well for revenue growth. Now let's take a look at the fundamentals of Netflix. Now, for every indicator that I talk about, it's all going to be framed around how Netflix can actually afford the Warner Bros. Deal. So first, let's talk about free cash flow. Currently, Netflix is printing $11 billion in cash this year. This is their secret weapon because they have so much extra cash, they're able to ditch the stock part of the deal and go all cash. By using cash instead of trading away their own stock, they aren't watering down your shares. They're using their record profits to buy a century of Hollywood history, stuff like Harry Potter, DC, Game of Thrones, without giving away a single piece of Netflix pie to WBD shareholders. Now, if they were to do a stock option for this, then they're going to be diluting your shares. You're going to, even though you own the same amount of shares, you're going to own less of the company than you did before. Now, let's talk about the interest coverage. That's obviously a big deal here, as they would be taking on a significant debt load to afford Warner Brothers. So bears are worried about the debt, but currently Netflix has an interest coverage rate of 17.2x. Netflix is in an entirely different league than its competitors. Most companies buying a studio would be struggling to pay the interest on their loans. Netflix currently earns 17 times more than their interest payments. They can take on debt for the Warner Brothers deal and still have a cleaner balance sheet than something like Disney or Paramount. They're sort of the safe haven of the industry because their balance sheet is just a fortitude. Now let's take a look at the margins, because that's obviously a pretty big deal because they have very nice margins. Netflix's margins are currently sitting at 31.5%, and that's key to making this deal profitable on day one. Netflix is so much more efficient than the old school studios. When they fold Warner Bros. Into their system, they can apply their high margin ad engine to all that new content. They aren't just buying a studio, they're Netflixifying it to make it twice as profitable as it was before. Because all of a sudden, you're going to take all this content like Harry Potter, Game of Thrones, and you can use the Netflix AI ad engine and get way more efficient ad placement, higher fees for those ads, with putting less total ads in the content altogether. The next thing I want to look at that's extremely important is the return on capital invested. Now, this is a stat that kind of proves that management knows what they're doing with the money, because currently they're at a 30% return, which is very good. So in the past, whenever Netflix has spent money, whether it was on Squid Game or the WWE, it turned into a massive return for investors. This 30% score gives me the confidence that this $82 billion deal isn't being wasted. It's being deployed by the best capital allocators in the business. So when people say, Netflix is taking a huge risk, this is a lot of debt, I want you to look at these numbers. They aren't betting the farm. They're using a position of extreme financial strength to end the streaming wars once and for all. This Warner Bros. Deal, it is going to be extremely expensive for them. I did the math earlier, and I believe the interest coverage right now, if they paid all their cash out and then they took the rest as debt, I think their interest coverage rate would fall all the way from 17.2 to 5.5. Now, I believe between 4 and 5 is the industry standard, and anything under 3 is starting to get kind of shaky. So they can definitely afford this deal, but it is going to be a significant debt load for them. But if you want to look at the other side of it, their revenue is estimated to go up by 35% after the deal is done in the following year. And, with their margins, that they could pay this down extremely quickly, as I expect they will. So now let's take a look at the bear case for Netflix. Now, if any of this stuff starts to come true, then I will definitely second guess having this stock in my portfolio, and I will consider selling. I'm not locked into an idea. Although I think Netflix is a great company, I do think there are some risks. So the first one is the mega merger curse. The primary reason the stock is currently tracing down is the $82.7 billion price tag for Warner Bros. Overpaying for content. Bears argue that Netflix is paying a massive premium, roughly 25 times EBITDA, for assets like HBO and DC, at a time when they already dominate the market. Integration nightmares. Combining two massive corporate cultures is historically value destructive. If Netflix spends the next 2 years fixing Warner's debt and corporate mess instead of innovating, they could lose their lead to lean competitors. Dividends and buyback drought. To save cash for this deal, Netflix has paused the share buybacks for many investors. That was the main reason to hold the stock, and without it, there is less support for the share price. 2. The regulatory wall. This is the hidden risk that could cause a sudden crash. Antitrust block. Regulators in the US, DOJ, and EU are currently scrutinizing the deal. If the merger is blocked, Netflix will have wasted millions in legal fees and months of strategic focus. To get this deal through, Netflix might be forced to sell off parts of Warner Bros. They actually want, which would lower the value of the $83 billion they're spending. 3. The saturated ceiling. Bears believe Netflix has simply won too much and is nowhere left to go. And because of a growth slowdown, Netflix 2026 guidance shows revenue growth cooling to 12 to 14%, down from 17% in 2025 in mature markets like the US. Almost everyone wants Netflix, already has it. And the price hike wall. Netflix is relying on price increase to grow. Bears argue that it is a limit to how much people will pay before they start canceling to save money. Now, these are some of the popular bear case theories that you're going to hear online, but personally, I think a lot of them are easily not really that true. Like, I don't think regulators are going to get in the way of this because, I mean, who else is going to acquire Warner Bros? Paramount? That seems like even more of a monopoly than Netflix acquiring it. And I also don't think that Netflix is going to be really forced to sell anything off because, as we saw in the fundamentals, Netflix they can afford this. It's expensive, but they can afford it. It's going to boost their revenue, and they're going to be able to pay it off aggressively with the increased margins on the new content. Now let's take a look at the bull case. So in January 2026, the bull case for Netflix has evolved from a simple subscriber growth story into a total media monopoly thesis. While the stock has been volatile due to the massive $82.7 billion Warner Bros. Acquisition, the underlying business is entering its most profitable era ever. Netflix is becoming the everything app. Netflix is no longer just a place for binge-watching TV shows, it is swallowing the entire entertainment industry. They have live sports and events with WWE Raw and some weekly NFL games, for example, over Christmas. They've been doing gaming expansion to get the attention of the Gen Z audiences with games like GTA and FIFA exclusive. So this is moving away from traditional movies and towards people who are into interactive play. With the Warner Bros. And HBO acquisition, they're getting powerful franchises like Harry Potter, DC Studios, and Game of Thrones. And, they're getting some of the most high premium content on the planet. That's what Netflix does with their own in-studio content. So I think even if they wanted to expand on some of these IPs, create new series, new movies, I think they could do it in a really great way. Netflix is effectively also double dipping on its users to drive record-breaking high margin profitability. The ad revenue doubling after 2025 to $1.5 billion. It's on track to double again to $3 billion in 2026. The margins are expanding. Management is targeting a 31.5 operating margin for 2026. This is the best in class, double the margins of most S&P 500 companies, proving that as they add more formats, add sports games, they're actually becoming more efficient and not less, as well as their brand new ad tier advantage. This is Netflix's fastest growing segment, providing a massive funnel for price sensitive users while generating higher total revenue per user than mid-tier ad plans. And don't forget, this company is a free cash flow fortress. $11 billion in free cash flow. Netflix is guiding for $11 billion in free cash flow this year. This is the fuel that allows them to fund the $82 billion acquisition in cash without destroying the company's balance sheet. They have self-funded content, while rivals like Disney and Peacock have had to cut content budgets to find profitability. Netflix is spending $20 billion on content this year, fully funded by their own operations. Their interest coverage is absolutely phenomenal at 12.2, and it's still going to be at a very healthy spot if this acquisition goes through. So I believe Netflix is a very powerful company, and I'm going to buy it on every dip I can for this Warner Bros. Acquisition because at the end of the day, people see this as something scary. I think that it's going to be a net benefit to the company in the long run. So if people want to sell and give me a discount based off an event that I think is going to be positive for the company, I'm going to take that every time. So don't be surprised if you see me adding to Netflix in this portfolio in the future. So the last thing I want to look at here is actually the valuation for Netflix at its current levels. So to do this, we're going to be looking at the PEG ratio today. So here's the breakdown. For 2026, Netflix is trading at a 27x multiple, but it's growing earnings at roughly 24%. When you do the math, 27 divided by 24, you get a PEG of 1.1. Now, what does that actually mean? If a stock has a PEG of 1.0, like just 1, it's considered fair value. It means you're paying exactly $1 for every dollar of growth. So to 1.1, Netflix is basically trading at its sticker price, which is crazy for a company this dominant in its industry, growing revenue this quickly with these kinds of growth prospects. Now, if we compare this to other companies, for example, Apple is sitting at a 1.4 and Disney is sitting way up at a 1.55. So while everyone is complaining that Netflix is expensive, it still is kind of expensive at 85 on some metrics. The math shows it's actually the biggest bargain in tech. So you're getting a world-class growth engine for a pretty fair value, while everyone else is paying a premium. This is how you find deals the rest of the market is missing, and I think that kind of goes hand in hand with the rest of my portfolio. As you can see, most of the companies I'm buying, except for QXO, are companies that have really not gone anywhere or have been pretty beaten down. Netflix has been pretty beaten down recently. MasterCard's been beaten down recently, but it's honestly just kind of stalled at its current levels. And Constellation Software has absolutely been beaten down recently. So, as you guys know, I sort of have, at this point in time, since this portfolio is new, I'm looking for good value, good entry positions in a pretty expensive market. I could go out there and I could start buying like extremely good companies like, NVIDIA, stuff like that, AMD, but I don't want to enter those positions at the current market levels. That's why my portfolio consists of these companies. The only one I would say that's maybe a little bit above at the moment is QXO. So with that being said, I hope you guys enjoyed the video. If you want to see more stuff like this and follow my public portfolio as it grows, hit that subscribe button. I make a video, ideally weekly, sometimes more than once a week. So I'll see you guys later. Peace.